Thanks for tuning into Talking Point on NDTV Profit. I'm your host, Neeraj Shah. Our guest today is, I can use the term indomitable, S. Naren. Naren, thank you so much for being a part of the show.
My pleasure.
Naren, tell us, for everybody who's invested in equities, I think the last few days have been a bit of a dream up move. Valuations may have been stretched, global markets may not necessarily have been the most supportive, but we've had a good move thus far. How do you approach equities currently?
See, it's a very, we manage other people's money, and we have been managing other people's money for a long period of time. So as far as the old money is concerned, people, I should thank all the people who have invested with us in the earlier days, because they got very good returns. Even for the people who have to consider, we are in a boom market. For a long period of time, we have had a boom only in mid-cap and small-cap in recent periods of time. If you look at the 2-year returns in large-cap, bulk of the returns have come maybe in the last 1 month or so. So we have a situation where the boom in large-cap has just started. And that is the challenge, how long this boom lasts in large-cap, because the valuations are not cheap. But for 2 years, large-cap has kind of underperform mid-cap and small-cap, and that is the challenge. We've looked at earlier years in ICICI on election years like 2009, 2014, and the challenge for us is, I think the quantum of rally is going to depend on the quantum of FII money which comes. And it is very difficult for a person like us to predict how much money will come, because they have not been investing after 2021. For 2 years, they have virtually not invested except for small periods of time. So it's a tough task at this point of time. But the real move, I think, is going to be in large caps, and how much the move will be, we'll never be able to predict.
Coming from you, that's an interesting answer, Naren. Is that because, one would presume that at some, valuations plus earnings would form a part of that. So and because you are getting the monies every month, what do you do, even if you can't predict? What are you doing currently then?
See, our model is very simple, that, when we get the money, we have to invest. And it is not that there aren't any fundraising happening. So if you look at this year, for example, on a continuing basis, we have had QIPs, we have had IPOs, we have secondary sale by a lot of private equity. That has ensured that a lot of the money that has been raised has gone into that actually. So it is not as if, the money has come and you just bought all the stocks in the secondary market. Bulk of it has actually gone into primary. If you look at these 3 groups, that is IPOs, QIPs and secondary sale by people like private equity. So that's what has happened actually. So it is not as if the money has just gone into the markets fully. That's not happened actually.
That's true. But so therefore, so when you get money which is scheme agnostic, let's say it's in a flexi cap scheme coming in, then you are comfortable probably putting more allocation to the large cap pocket, because I heard you use the term boom when it comes to large caps and not as much in mid caps and small caps. Would that be a fair assessment?
Behaviorally, I keep telling my colleagues in my team, invest more in large caps. But imagine the kind of boom we have seen in small cap and mid cap. It's been very tough to say I won't invest in mid cap and small cap, because every mid cap and small cap goes up like one rocket.
That's true.
Whereas if you look at most of the mega caps over the last 2 years, what returns have they given? They've given hardly any return. So it is not as if any AMC would have said, I'll not invest in mid cap and small cap. I'm sure even in the flexi cap funds, there would be a fair amount of mid cap and small cap at this point of time. Because the reality is that if you had avoided all the mid cap and small cap, it would have been very difficult to do returns.
But here on?
Here on, I really think 2024 is going to be a year of large caps.
Large caps, okay.
Because you have had 2 years of, very little money coming from FII. And I think 2024, the returns have to come if FIIs come. If FIIs say, I'm not going to invest, I don't think you're going to have big returns, because I think domestic investors have invested significant amount of money.
Most certainly. Thanks to mutual funds, PMSs, AIFs, etc., the amount of Indian equity in the hands of the Indian investors has been fairly large, which is a good sign. Okay, let me try and And we'll come to the risks as well, Naren, because I'm sure in your mind, whenever I've spoken to you in times of euphoria, you're the first to highlight the risks as well, and we'll come to that. But I first want to dissect how you're thinking as a portfolio manager about what within this bucket as well. So banks have started to move, yes, but clearly far away from the kind of gains that Nifty per se has made as a benchmark, or some of the other sectors have made as well. Is there a case for banks to give good returns over the next 12 to 24 months? Why or why not?
I think banks will give reasonable returns, but banks as a sector is not an underinvested sector among all the funds. So if we are all going to get money and FIs are going to get money, what is the sector they'll invest in? Banks certainly. So I think banks are certainly going to do well as money flows. At the same time, if money flows out, they are the sector which people sell. So you have to keep that in mind. But from a cycle perspective, I think it's the sector where there's been fair amount of negative impact of net interest margins peaking out. There have been a lot of concerns. I don't think there is any big risk of near-term non-performing loans going up. The corporate sector has been in fine fettle. I think the banks with a very good deposit franchise are going to do well over the next 2 years. But finally, it's dependent on flows. Banking is dependent on flows.
Okay.
If FIs get outflow, they'll sell banks. If domestic get outflows, they're going to sell banks. If on the other hand, if each of us are going to get inflows, we are all going to buy banks because it's almost 30% of the benchmark or more than that at this point.
Yeah, but domestics have gotten flows thus far, and yet banks, despite having good valuations or valuations in their favor relative to the recent historical averages, haven't quite moved. So do you think now finally the time can come, because along with domestics, if FIs also get in money, that's when the money will,
absolutely,
that's when the move
absolutely,
will happen.
I think that is clearly the situation.
Okay, what about NBFCs? There is enough warning given by the Reserve Bank of India as well around unsecured lending. Again, if a rate cut trajectory is something that we anticipate in 2024, that might have a bearing for both NBFCs and banks as well. So how do you look at NBFCs in that regard?
See, in NBFCs, you have to be much more careful. I think the real area where we have to be careful is fintechs, but fintechs are not listed. So luckily for us, we don't need to look at them. In the case of NBFCs, there are some fantastic NBFCs who manage risk as well as a bank. So in those cases, we have to do actually a valuation analysis rather than a risk analysis at this point of time. And it's not that they have mismanaged their risk in a way that we have to worry about. But NBFCs are also, there are good NBFCs, average NBFCs, below average NBFCs, there are very good NBFCs. You can't look at them and say, you can say all of them are one way and say either positive or negative at this point of time. And the reality at this point of time is, I think the deposit market is equally important. The people who are able to raise resources cheaper, I think they have a good situation, whether it is in the NBFC market or in the banks market.
Got it. Then what about non-lending financials? There, the performance has been fairly divergent within the capital marketplace as well, wherein AMC stocks haven't quite given the returns that some of the others in the capital marketplace, be it the brokers, be it some wealth managers, be it the platform companies have. And then the non-capital marketplace, insurance, you would argue that you can almost say that they have been stagnant, if you will. I mean, I was looking at returns of the private insurers since 2017 that they have listed. A 7-year return is 120%. That's nothing to write home about, really. So what about the non-lending space, non-lending financial
I think
space?
you have to go bottom up there.
Okay.
And I mean, some of them have gone through sideways movements for some periods of time. So I think we have to do a lot of bottom-up work there and then do the analysis. So I think as such, it can't be one way looking at it. And some of them, the cycles have actually, last year they had a fantastic January to March. So the base effect is a challenge for the next 3 to 6 months. But once people realize it's actually a base effect in play, I think people will realize that the long-term outlook is still good and you can't look at year-on-year trends. How many people look at year-on-year trends is going to be interesting, because last year Jan to March was fantastic for various reasons in insurance. So people shouldn't look year-on-year. If they start looking at year-on-year, the near-term will look average in insurance. And that is, those are the kind of things that we have to look at. See, as such, if you look at the market, there is no pocket which is very, very cheap.
Agreed.
I mean, we have had a such a big bull market that if we come and say, okay, I'm going to look at this area of the market, this is very, very cheap and invest aggressively, that scope just doesn't exist at this point of time. You have to look for only relative cheapness or hope for a trade which moves from being fairly valued to overvalued. That is a trade that we have to look for. Can it happen? Yes, because India is one of the few structural stories in the world at this point of time. And for a person like me to say, okay, I look for a trade from fair value to overvaluation is something which is very tough for me. But it is something which could well happen in the year 2024 at this point of time.
And what would be the catalyst for such a thing? Earnings growth or the fanfare around investments that might be happening? What could lead to that?
The catalyst is actually that Fed cuts rates. Then people say we have to invest in emerging markets. Then anyway, domestic flows have never slowed down. So you have domestic flows. On top of it, FII flows. Actually, in the last 2 years, you have had a situation where you had domestic flows, but not enough FII flows. So you have, if you have a situation where you have both domestic flows and FII flows together, that makes for a very, very uncomfortable market for people who look at valuations like we do at ICICI.
Got it. Just before we take that break, and then we'll of course talk about some of the pockets that Naren particularly may be liking. But just wondering, Naren, there are people who are saying that there is a very high probability because of all the factors that you mentioned and the fact that we are looking reasonable on growth on the country front as well, that India may eventually be the emerging market which may reach stratospheric levels on valuations, even bubble territory, because there are not too many games in town. Would you, when you scan the global landscape, do you get such a feeling too?
It is possible. See, markets in the near term are completely unpredictable. And when we look and compare all the big emerging markets in the world, how many markets are there where you have a macro where fiscal is under control, current account isn't under control, inflation is under control, corporate sector is in good shape, and the only problem is high valuation? I'm not able to see an emerging market with all these situations. So can it be? But does it change? See, valuations can go up in the near term, but in the very long term, valuations do play a role. And that is a challenge, particularly when we are managing other people's money.
True.
So in the near term, valuations can go as high as anything you want. And this is the learning from years of managing other people's money.
But is there a case that this can happen in 2024?
There is a case that it can happen in 2024, and it's a worrying case when you're managing other people.
Okay, great. Now, Naren, I've asked you about one of the key pillars, which is the largest weightage, which is financials, and we've discussed that at length. I would love to understand, where is it that you believe that earnings growth looks set as remaining strong, or the probability of earnings growth is strong for the next 2-3 years, because there are a lot of pockets in which either there is government capex happening. I know export demand is not quite there, but maybe possibilities later. So what is it that S. Naren likes?
See, I think we clearly like mega caps. See, over the last 3 years, what has happened is slowly, if you look bulk of our funds, you will find that mega caps have done so badly compared to small cap and mid cap. So people have asked this question, go across sector, you will find that the smaller banks have done very well against the larger banks. Look at the smaller IT companies have done very well against the larger IT companies. Look at the smaller consumer companies have done very well against the larger consumer companies. So across sectors, what you see at this point of time is that the mega caps have done badly compared to the smaller companies. And if you look at, by and large, the portfolios also, you will find that people are underweight the mega caps compared to the benchmark, and they have benefited out of it. So I think this is the year where you go and say, let's buy the mega caps, because the mega caps have had now 3 years of big underperformance.
Yeah, sure.
And people have asked us 3 years back the question, why don't you have these mega caps? And at that point of time, it was a tough time to tell people they are not looking cheap. The mega caps or the quality stocks at that point of time, they were not looking cheap compared to the small caps or the PSUs or the telecom companies or the metal companies and various other things. 3 years later, those companies have gone sky high, and these companies have barely participated. So this is what we think at this point of time, and this is to execute this, and then you never know how long these trends changed, how long you go back, and that is where it is. That is where there is relative value. As I said, there is no pocket of where
Fair
markets
valuation.
you can say is absolutely cheap. So you look for relative value at this point of time.
But within what themes? I mean, mega caps, there are a few of them, but they are present across multiple sectors, but with maybe one or two sectors being the key drivers. So what within this mega cap universe thematically do you like more?
Everywhere you go across, as I said, you go across banks, you go across consumer companies, you go across IT companies, you go across conglomerates. Everywhere that is the situation at this point of time. And if you look at it, no, one of the things that we believe at ICICI is bad news and bad share price go together. Good news and good share price go together. 3 years back, people said, how can PSUs deliver? And it looked like PSUs can't deliver.
Yeah.
Today, does anyone ask these questions? No one asks these questions. So somewhere, no, and today you can find a reason and say this mega cap has this problem. That mega cap has that problem. I'm sure you'll find an answer why this mega cap is not delivering. But the reality is that, you know, good news and good share price go together. So we look for bad news and bad share price to go together. And then sometimes some of these things revert back to mean. And the challenge is patience. And that's how we think about it at this point of time.
Yeah, so I can completely buy your point about how banking mega caps, for example, haven't quite had the move. There is a case maybe for valuation multiples to re-rate, as the case may be. What about information technology there? There are a few out there which haven't made a move, but the arguments that come in on almost all notes that I read is that discretionary spend, if anything, will not come back in a hurry. So is technology on the back burner, or do you think even tech, there is a case being built there?
I think no, basically you maybe in these sectors you will have to buy more gradually, because the near-term outlook looks so bad. But it is not that, you know, information is democratized now. Does Neeraj know it? Yes. Does the viewers of NDTV Profit know it? Yes. Does so many people know it? Yes. So what happens is, over a period of time, everyone knows that the outlook for discretionary IT expenditure in 2024 is bad. It gets priced in. And once it gets priced in, sometimes what happens is the opportunity still exists because almost everyone knows it. And everyone goes underweight the sector. And that happens. And that is part of investing today, because compared to the 90s, what is different between 90s and today is that information is fairly democratized. Even if you have a good internet connection and a good laptop or an iPad, you will know that there is a problem in discretionary IT expenditure in 2024.
That's true. Okay. So in some sense, that's some of those areas where you can play contrarian. There is also this, of the last 12 to 24 months, things which are export oriented, Naren, are languishing, and for the right reasons. Possibly that 2024 also could be a year where they may not come back. But this whole spec chem, select pharma, other pockets which have a large export piece and are multi-year themes, I presume, and haven't done well. Is there a case anywhere wherein the valuations are attractive enough for you to invest, or for one to invest, even if one knows that for the next 6 months they may not do much?
See, everything looks like a very good SIP model rather than a big lump sum model. Because see, at some point of time, if you had asked us 6 months back, I would have said I would wait for a big fall to buy. Now, given the environment of the markets, how do you know there'll be a fall? So it's better to do SIP and say, because finally at the end of the day, over a 3-year period, you're not going to have a situation that some of these companies are not going to recover. So whatever level they come to, they're all attractive. So you do SIP instead of saying wait for that big fall, because that big fall may never come. Yeah. And that is how it looks like at this point of time, given that India has arrived, and that we have to accept that India is one of the best structural stories at this point of time from a growth standpoint over the next 3 to 5 years.
Okay. Naren, valuations notwithstanding, whether you invest now, next year, or the year after notwithstanding, if I had to ask you structurally from a theme or a sector perspective, what are those where you believe the story is multi-year in nature and the earnings growth possibility over the next 3, 4, 5 years is very high? Because there's a clutch of these wherein the book-to-bill ratios, for example, in defense are so high, in railways are so high, chemical companies talk about orders and plants being set up with a 3, 5, 7-year perspective. Where is it that you are most constructive from a business angle, not from an investment angle, because investment would also involve the valuation that they are trading at?
See, that way, if you look at it, if you don't look at the cycle, near-term risk cycle, I think financials certainly look good from that point of view. I mean, if you look at it, you know, many of these cycles which, for example, some of the discretionary consumption sectors are going to do pretty badly over the course of the next year. So those are all sectors, you know, frankly, these are the sectors. See, there are sectors, if you look at staples, for example, or retailing, for example, they've been doing pretty badly. So those are all sectors, frankly, you would want to buy into a correction. The challenge from an investor point of view is you want to buy at a certain price.
Yes.
That price is not coming. And you know that the near-term outlook is bad in some of these sectors. But despite that, those price points that you are looking for, they don't come. So at the same time, you know that the next 3 to 5 year outlook is good. So how do you buy? That is the challenge we are looking at. And that is where investing has become much more complex for us, because if you are in many other parts of the world, the kind of corrections that have been seen in many other stocks, barring those 7 stocks in US, if you look at it, by and large, across the world, you have had meaningful corrections in the market, giving you those opportunities to buy. Whereas in India, it's been tough to do stock picking because those stocks were cheap in 2020, 21. But in 23, it has not been an easy task to identify those cheap stocks.
Yeah, and as you said, that there's a very, I mean, there could be a case made that that may not even come, because it's very difficult to call that.
So one of the lessons we learned over a period of time is you want capitulation. Doesn't mean market will capitulate just because you want capitulation. It doesn't happen. Like, for example, there are times when capitulation happened. Credit market capitulated in 2020. It's not that we wanted it, but it capitulated. So people seem to think that just because you want capitulation, capitulation will happen. It doesn't need to happen. That is why somewhere these models like SIP work, because they don't believe in capitulation, they believe in steady investing.
That's true. That's true. Naren, what are the risks on the horizon, aside of valuation risks?
See, the risk is, you know, consensus always works normally with some problems. And the problem is we always overrate our capability to assess risk. Did we ever know that there will be a problem called COVID? We had met in 2019 December.
Yes.
Would I have ever told you that there will be a risk called COVID? Answer is no.
So nothing on the horizon.
So the fact is that consensus itself sometimes can be a risk. And the fact that, you know, retail investor interest in the form of derivative markets and the kind of interest that they have shown through derivative markets constitutes a risk. And the fact that, as such, if you look at the way RBI has taken this entire personal loan capital adequacy, and I believe always the central banks know much more about the economy than you and me. So the fact that they took this capital adequacy decision means that they know that, see, today we understand corporate sector. We meet them. Corporate sector is in great shape. We understand government finances because data comes on government finances periodically. I think government has managed its finances reasonably well. So on the retail side, there must be something that central bank says when they say, no, we want banks to lend lower to retail sector. So I believe that there is some worry I have on the retail leverage in the equity market and the retail leverage through personal loan market. The fact that I am not leveraged, and the fact that people whom I know are not leveraged, and the fact that I do not, as per compliance, no one I know can trade derivatives, means that I may not know what's happening in these markets. But the aggregate position, for example, in derivatives market, every day is not low at this point of time.
Point well taken. Point well taken. And well noted, I'm sure, with the viewers as well. But yes, Naren, it's been a pleasure talking to you today. Thank you so much for giving us all your wisdom, and look forward to have you more often on this platform.
Wishing everyone a happy viewing experience in NDTV Profit, and a happy 2020.
Thank you so much. It means a lot, Naren, coming from you. Really appreciate your time.
Thank you.